This week, the American stock market stumbled again. Not because of earnings. Not because a bank failed. Because of one number, from a market most people never look at. 5.21%, what the United States government must now pay to borrow money for 30 years. The highest price since 2007. Before the iPhone. Before the financial crisis. The bond market is where the world sets the price of money itself. It is bigger than the stock market, and it outranks it. Right now that market is in open revolt. Against a war, against inflation, and against Washington's credit card. In the next 10 minutes, what these bonds actually are, who really sets interest rates, spoiler, it is not the Fed, and why this revolt is the invisible ceiling pressing down on stocks. Welcome to MetaCortex, where we explain technology and money, and how they shape your investments. Last episode ended with a promise. We would show you who actually owns the national debt. Today you get the answer, inside a bigger story. Ground rule, as always, we explain how things work. Nobody here tells you what to buy or sell. Every figure today comes from this week's data. Treasury closes, Fed statements, oil prices, and it's all sourced and linked below. Strip away the jargon. A bond is just a loan, cut into a tradable piece of paper. When you buy a Treasury bond, you are lending money to the United States government. Say, $1,000 for 10 years. In return, the government mails you interest, the coupon, about $47 a year at today's rate. Small on its own, but it lands every year, and it stacks. Watch it. Year 3, 140. Year 7, 328. By year 10, $468 of interest. And then, the maturity, your $1,000 comes home on top. $1,468 back, on $1,000 lent. That yearly return is the yield. Because America has always paid, through depressions, world wars, and defaults everywhere else, the Treasury yield is nicknamed the risk-free rate. And that makes it the floor of the entire financial world. Mortgages, car loans, corporate debt, stock valuations, every one of them is priced on top of this number. When it moves, everything moves. Now the one mechanic that unlocks every headline this week. Bonds are traded second-hand, like used cars, and a bond's price and its yield sit on opposite ends of a seesaw. Imagine you hold last year's bond, paying 4%, but new bonds pay 5%. Nobody will buy yours at full price. Why would they? To sell it, you must discount it. Your bond's price falls. And for whoever buys it at that discount, the return, the yield, rises. So when you hear that yields are surging, hear it precisely. Bond prices are falling. Investors are selling. Highest yield since 2007 is a polite way of saying the world's safest asset is having one of its worst stretches in a generation. And every new dollar Washington borrows now rents at the new, higher price. The government doesn't borrow at one rate. It borrows across time, and each maturity has a different job. The 2-year note is a bet on the Fed's next moves. Today it pays 4.23%. The 10-year is the backbone of the system. It prices mortgages and stock valuations, 4.68. The 20-year, the pension fund's yardstick, 5.22. And the 30-year is the trust gauge, what the world charges America for a promise one generation long, 5.21, the level last seen 19 years ago. Notice the staircase. The longer you lend, the more they charge. Plotted as a line, that slope is the famous yield curve, and this year, the long end of it broke away violently. Here is the twist most people never hear. The Federal Reserve does not set these numbers. The Fed controls exactly one rate, the overnight rate, currently 3.5 to 3.75%. If you want the full machine, our Fed episode is linked below. Every longer rate is set at auction, by whoever shows up to lend. Pension funds, insurers, banks, foreign governments. And look at what those lenders are saying. The Fed cut rates last year, and has sat still all of this year. Yet the 2-year, the purest bet on the Fed's future, has climbed to 4.23, well above the Fed's own rate. Translation: the bond market is betting the next move is a hike. Even the Fed's own July projections shifted up. The dial hasn't moved, but the market has already voted. So what set the bond market off? Start on February 28. American and Israeli aircraft strike targets across Iran. The supreme leader is killed. Iran answers with missiles, and with geography. On March 2, it closes the Strait of Hormuz, the channel carrying roughly a quarter of the world's seaborne oil and a fifth of its liquefied gas. March 19, an American air campaign to force the strait open. April, a fragile, brokered ceasefire, and a naval blockade of Iran's ports. June 14, a memorandum meant to end the war. But July proved it isn't over. Tankers attacked on July 6 and 7, American strikes in reply. Every one of those headlines hits the same market first. Not stocks, oil. Follow the price of Brent crude through the year. January, $72 a barrel, a calm, oversupplied market. War eve, 71. Then the strait closes, and the price goes vertical, $138 by the 7th of April. The truce pulls it back, all the way to 70 in June. The war premium almost gone. Then the July tanker attacks, back above 100, before settling near 92. What that did on the ground? Gasoline at $4.10. Inflation re-accelerating to 4.2% in May, energy prices up nearly 16% in a year. Inflation is the bondholder's mortal enemy. It eats fixed coupons alive. But notice, oil is now halfway back down, and yields kept climbing anyway. The bond market's problem is no longer just oil. Now the same year through the bond market's eyes, the 30-year yield. From last summer into February it drifted down, 4.9 towards 4.6. The market was pricing a calm world and more Fed cuts. February 27th, the day before the war, 4.64, the low of the year. Then the climb, through the oil spike, through May's 4.2% inflation print. Past 5, a brief June calm, and then July, the tanker attacks, a defiant inflation report, and a Federal Reserve that held rates but sounded worried. On July 29th the 30-year cleared 5.2, the highest since 2007. Nearly 0.6 of a point in 5 months, and every step of it tracks the war and the deficit, not the Fed's dial, which never moved at all. There is a second engine under this revolt, and it was running before the first missile. Supply. This year Washington borrows $1.9 trillion of new money, while interest on the old debt crosses $1 trillion a year for the first time. More than the entire defense budget. So who buys all this paper? The answer we promised last episode. Foreigners hold a record $9.5 trillion. Japan is number 1, at $1.2 trillion. China, $694 billion, shrinking year after year. The Fed? Out, letting its pile run off since 2022. The buyer who matters now is a private investor with choices, including a flood of AI data center bonds bidding for the same dollars. Choosy lenders charge more. That is a rising yield. So how does a bond yield cap the stock market? 3 ways. 1. Gravity. The risk-free rate is the hurdle every investment must beat. When it rises from 4 to 5, tomorrow's profits are worth less today, and expensive, AI-priced stocks feel it most. 2. Competition. Doing nothing now pays 5%, guaranteed. Every stock competes with that offer. 3. Cost. Companies refinance on this same curve. Now watch the tape. Wednesday, a hawkish Fed, the 30-year spikes, stocks sell off across the board. Thursday, yields ease. The S&P rebounds 1.7% to 7,437. Same companies, same earnings, the only thing that changed was the gravity. That is why every push toward new highs keeps stalling. And this reaches your street, fast, because the 30-year mortgage follows the 10-year Treasury, not the Fed. This week the average mortgage hit 6.66%, the highest in a year, rising 4 straight weeks, while the Fed's dial hasn't moved since December. Car loans, credit cards, small business credit, all repriced off this same curve. One consolation, for the first time in a generation, savers get paid. Parking cash in short treasuries earns around 4% with zero drama. But the lesson under all of it, the bond market, not the central bank, writes the price tag on your life. The Fed didn't raise your mortgage this month. 40,000 bond traders did. Zoom out, because this is global. The Fed, holding at 3.5 to 3.75, but the vote was 9 to 3, and the dissenters wanted tighter. The European Central Bank, hiked in June on war inflation, now holding at 2.25. The Bank of England, held at 3.75, 3 of 9 wanted 4%. And the Bank of Japan, its rate stands at 1%, the highest since 1995. Japan is the one to watch. Japanese institutions are the largest foreign lenders to America. When bonds finally pay at home, that money stays home. The world's biggest treasury buyer is being paid to walk away. Across every desk, the same message: nobody is cutting anymore. Free money is not coming back. The lessons, older than every headline. The Fed sets one overnight rate. The bond market sets all the others, and it votes every single day. Bond yields are gravity. Every asset on earth, your house, your index fund, is priced on top of the risk-free rate. Inflation is the bondholder's enemy, which makes every oil shock a bond event before it is a stock event. Deficits are not abstract. When the borrower asks for more, the lender charges more. $1 trillion in interest is that rule, compounding. And the practical one: watch the 2-year to know what markets expect from the Fed, and watch the 30-year to know how much the world still trusts the system. The whole story, In 30 seconds, America's long-term borrowing cost just hit 5.2%, the highest since 2007. A war closed the Strait of Hormuz, oil touched $138, and inflation came back. The oil spike faded, but a $1.9 trillion deficit and fading foreign buyers kept yields climbing anyway. The Fed is frozen at 3.5 to 3.75, and the market is quietly priced for the next move to be a hike. And 5% risk-free is the ceiling pressing on stocks, and the floor under your mortgage. The bond market has voted. It always votes first. If you want the machine that sets the overnight rate, the printer, the dial, the whole apparatus, our Fed episode is on screen now, and the crash those margin calls caused is next to it. If this made the bond market make sense, subscribe. That's the whole ask. It's how the machinery behind the next headline gets explained the week it breaks.